Just a moment. I'm happy to welcome all of you for this webinar on financial analysis, must skill for every banking executive. I also wish to title this webinar as how to analyze financial condition of business without going through years of mainstream finance education. We are now living in the world of online education. COVID lockdown has opened up the possibilities for online learning. In the past several months, you would have attended various webinars, various workshops, online programs. You would have attended your own organizational internal training. But despite all this, if you have registered for this webinar, if you are attending this webinar, it means you are seriously looking for some guidance, you are seriously looking for some learning resources. I can give you that assurance. That is, your next 60 plus minutes is going to be the valuable time. You will have lots and lots of takeaway in this next 60 plus minutes. What you require is guidance from right person. I can give you enough guidance. I can act as a resource person for you. That's the assurance from my side. Okay, so what is the objective of this program? What is my goal? My goal is basically to help out two types of executives: bank executives and finance executives. They should learn financial analysis. Bankers, they should learn financial analysis because when they sanction loan to a borrower, they do credit appraisal, credit analysis, and in that, financial analysis is the core. So bank executives, especially credit analysts, credit managers, relationship manager, branch manager, credit risk creator, sales manager, they should have a good knowledge of credit and financial analysis. Similarly, finance executives, they should understand how banks are going to evaluate their business. They should understand what are the expectations of the lenders so that they can equip the financial position of their business as well. So that's my goal here. Twin objectives: one is to help bank executives, the other one is to help finance executives. So shall we begin? Are you ready? If you are ready, type start. If you are ready, type start. Thank you very much. Let's go through a small story. Over a period of 5 to 6 years, I was training thousands of bank executives on topics like credit analysis, financial analysis, working capital, term loan. This is happening for the past 5 to 6 years. But all this did not happen just like that, because I need some foundation, right? How I am teaching this, from where I have learned all this. Let's go back to 2008. In 2008, I joined SBI as credit analyst immediately after my chartered accountancy qualification. I used to say it's just one day before completing my CA program. In campus interview, I was selected. So I had this tag CAN Raja, BCom PGDBA FCA, chartered accountant, and I had that bit of headweight also because completed CA in first attempt, got job in SBI, that too joining as credit analyst. Wow. Okay. So I joined SBI, and first 3 to 4 months that gave me literal nightmares, because the profile of credit analyst, credit analysis was not as simple as what I thought. Because in CA final and all, we have done extensive, complicated study analysis, everything. But when I faced that reality, it shocked me. Day in and day out, we'll be getting balance sheets of corporate customers, business entities. You have to read the balance sheet, you have to analyze, you have to read line by line items, you have to read in between lines, You have to arrive at ratios, you have to analyze, interpret them, then see their cash flow statement, fund flow statement, then do the credit risk rating, then put up a appraisal, then attend committee meetings, get firing, answer the questions, and in the meantime 3 to 4 other proposals will be in queue. Again, you have to analyze different set of customers absolutely with the different business models. So first 3 to 4 months was absolute nightmare. Despite being a chartered accountant, I faced lots and lots of difficulty in understanding what this credit analysis and financial analysis is all about. But thank God I had good mentors in SBI. They guided me. With their guidance, I was able to pick up things very fast. And within a period of 1 year, I got elevated as team leader of credit processing cell. And over a period of 4 years in SBI, I worked on 250 plus projects. It's 5,000 crore plus size. But what I came across is, despite being a chartered accountant, I struggled a lot. And when I was elevated as team leader, I had newcomers reporting to me who are basically from non-finance background, engineers, science graduates. They struggle in understanding basic accounting. Then comes balance sheet, then comes financial analysis. They had so much of difficulties. So at the time, they used to ask me to teach on basic things. So in the evening time, I used to teach them what is accounting, what is balance sheet, what are ratios, cash flows, fund flows. It started then. It started in 2008 onwards, I can say. And this journey continued for a period of 4 years. Then I came out, I got into CA practice. I had my practice for a period of 7.5 years with more focus on project funding, debt syndication. So again, what I witnessed is, whenever I go to bank, whenever I represent a client, the bankers on the other side were found to be on the weaker position, because client has good knowledge of his business, but bank executive, they are basically shifted from some other department and they have very little idea about what this financial analysis is all about, and many times they fumble. I've seen this. So I started training bankers on credit and financial analysis areas so that they can approach or they can face their customers very confidently. I started teaching through bank internal training programs. I also empaneled myself as trainer with a few banks. Then I explored technology. And thanks to technology, today I teach close to 2 lakh students, of which 1,81,000 plus students are in Udemy portal, 20,000 students or close to 20,000 students or in my own portal CA Raja classes, and 95,000 plus subscribers follow our videos and lectures in YouTube. So in this backdrop, I wish to ask you once again, are you really serious about learning financial analysis? Are you really serious about learning financial analysis? If yes, please type this: ISAFA. I am serious about financial analysis. Just type ISAFA. I'll keep asking you to type out some small things like this. It's basically to ensure we are connected. For me, it happens now and then. Without any notice, my internet connection will go. Okay, so that can happen even today also. So if at all that happens, I would request you to stay back for another 5 to 10 minutes. In the meantime, I can make some other alternate arrangements. Okay, so if you are serious about learning financial analysis today, type ISAFA.
Let's get started with today's presentation: Financial Analysis Must Skill for Every Banking Executive. As a bank executive, why you have to understand financial analysis? Remember one thing: what is the core business of banking? The core business is lending. And how bank takes that decision? They take that lending decision by carrying out something known as credit analysis, and in that, financial analysis plays a very significant role. So if you want to rise up in your organizational hierarchy in bank, you should know what is the core business of banking, and you should be in a position to take that decision as well. So for that, you have to understand the elements, the factors related to that, and in that, financial analysis is very, very important. Financial analysis of whom? Financial analysis of borrowers. Because when they come to the bank approach for a loan, the bank should be in a position to evaluate the customer, then take a decision, and they can do that partly by carrying out financial analysis. And when I say financial analysis, it is analyzing their financial statements, the audited or the past financials, and also their estimated projected financials. And for carrying out that analysis, we are going to use three critical tools. One is financial ratio analysis, two is cash flow analysis, and three is fund flow analysis. Let's get started with financial ratio analysis. I'm going to take you through an example. Let's say there is company A and company B. Company A has reported a profit of 10 crore and company B has reported a profit of 5 crore. If I ask you which company had performed well at this point, what will be your answer?
It's a simple question. It's like taking a baby step, but still, I want you to participate. Some of you may feel like information is inadequate, so you could not take a decision and all. But still, let's take that baby step. Okay, I'll do one thing. I'll just conduct a small poll. You can participate in that poll also. Yeah, now cast your vote. Tell me, like, which company is performing better? Is it company A or company B? Okay, on one side we have election results out, and here we have voting happening at a good pace. Okay, so far there is 70% voting, and let's see how this goes. It's going to be like 45 seconds poll. 3, 2, 1, done. Okay, and let me share the results now. Let me share the results now. Have a look at the results. And what you are seeing, what is who is the winner, A or B? Who is the winner, A or B? And what is the percentage you are seeing on screen? Can someone type? You see A as winner. It means how many of you concluded A? What is the percentage? What is the percentage? Yeah, more than 90%. 91% of you favored A. You have casted vote in favor of A. 91%. It means 91% of you said company A is performing better. Okay, let's continue now.
Most of you would say company A, right? Because company A has reported a profit of 10 crore. But if I supply you one piece of information, that is the sales achieved by this company, company A has achieved a sales of 100 crore and company B has achieved a sales of 25 crore. And if I ask you once again, which company has performed well now, what will be your answer?
Earlier, many of you felt that I have given inadequate information. I'm actually forcing you to take a decision. Okay, now I have supplied something important and relevant information. And remember one thing, earlier 91% of you favored A. Okay, 91% of you favored A. Now let's look at the kind of shift that is going to happen. I'm relaunching the poll. Okay, just a matter of touch or click. Okay, please cast your vote now. Now tell me which company is performing better. Is it company A or company B? I know it's very elementary. This is not rocket science. I'm not teaching you something hi-fi super, and I'm not teaching you everything of financial analysis. We are just taking our baby step, but you are going to see the kind of impact financial analysis can have on your decision. Okay, that's what I'm trying to bring out here. Okay, so it's going to be like 45 seconds poll. Please, whoever have typed also, please cast your vote now. Okay, because we want to see the aggregate position. Earlier we had 70% voting. Okay. Yeah, now it's actually 79% voting. And let me end the poll. Let me end the poll. I'm sharing the results and look at the results. There is a drastic shift. Earlier, 91% of you favored yay, but now it's only 19. I mean, it just got reversed. From 91, it gone to 19. Earlier, only 9% favored B, but now it is 9 to 9 times 81% favored B. What happened? See, earlier you took a decision based on raw data, okay, and 91% selected A. But when I supplied you that additional piece of information, the critical information, the logical information, which you can relate with, you did that analysis. I believe you did that meaningful analysis. And I believe you have taken a quality decision, right? How many of you agree with me that you have taken a quality decision now? Because earlier you have chosen A, but now you have selected B. And how many of you believe that B is yes actually performing better comparatively? If you believe yes, type yes. Okay. It means, see, even now there are many other factors, but let's take our baby step. Okay, we'll take our first step, then we'll go to second step, third step. There are various other factors. But given this information, now we can conclude that B is actually performing better than A. Earlier, 90% or 91% of you said A, but many of you could change your decision. It means now you have taken a well-informed decision. Earlier, decision was taken on the basis of raw data. Now it is analytical information, and you have taken a quality decision. And that's the power of financial analysis. That's why I said financial analysis is the core. Okay, so thank you very much for joining this webinar, and let's get into the world of financial analysis. And this is the way in which we are going to learn. And if you find this way of learning interesting, type cool. If you find it super cool, type super cool. But again, I admit it's not a rocket science. I've just taught you basic thing. But if you find it cool or super cool, type.
There will be a drastic shift, right? Because earlier most of you would have favored company A, but now majority of you will be favoring company B. What happened? When you looked at the standalone figure, it was deceiving because profit of 10 crore looked better than profit of 5 crore. Yes, that's true. But when you gone deeper by comparing the profit with sales, you were able to calculate the profit margin. Company A has reported a profit of 10 crore on 100 crore. It means they have a profit margin of 10%. Whereas company B has reported a profit of 5 crore on 25 crore. It means they have profit margin of 20%. So what's happening? Company B has performed well. In this case, what we have done is we have compared the profit with sales and we have calculated this ratio. Profit by sales into 100. That is what we have calculated as profitability or profit margin. Okay. So ratios are basically a relationship between two numbers which are created in a logical way. Yes, we related sales and profits, and it's a relationship between two numbers, and there was a logic in relating the sales and profit because we can measure profitability. We related current assets and current liability to numbers, and the logic is it helps us to understand the liquidity. Okay, so ratios are relationship between two numbers which are created in a logical way, and it will help us to understand the past, present and future performance, and it will also help us to understand the strengths and weaknesses of businesses. Yes, by looking at the profitability ratio, we were able to understand like which company is performing well. So we have understood the strength and weakness. So like that we can give many variations. Okay, so that's about ratios, and we are going to understand the ratios by looking at its classifications. Ratios are broadly classified into four categories. They are liquidity ratios, capital structure or leverage ratios, activity ratios, and profitability ratios. First, let's get started with liquidity ratios. Already I explained what is liquidity. Liquidity is basically ability of the business to meet its short-term expenses, short-term obligations without difficulty. At this point, I just want to bring the balance sheet here. So those who don't know what is balance sheet, Balance sheet is a simple statement which will show from where and all money had come for business and where and all that money had been used. Okay, so for business, money can come from owners, we call it as equity. Money can come from outsiders, we call it as liabilities. When money comes from outsiders, it can come with an obligation to pay within 1 year or pay after 1 year. If it comes with an obligation to pay within 1 year, we call them as short-term liabilities because we have to pay within 1 year. And using these money, which are basically raised as repayable within 1 year, which we call them as short-term liability, we can use this liability money to create asset, that is short-term asset. But if you look at this, the short-term assets are greater than short-term liability. How it is possible? Because the short-term what is raised in yellow box is smaller, but short-term assets are larger. It means this short-term assets could not have been created without the support of some long-term funds, because only a portion of short-term assets are funded by short-term liabilities. It means there got to be some remaining funds which have been used in creating short-term assets, and that's how it should be for every business. Short-term assets should be greater than short-term liabilities, because short-term liabilities are those liabilities which you have to repay within 1 year, and for repaying that you need resources. Resources will be in the form of short-term assets, so the resources should always be greater than the obligation. That's why I've captured the short-term assets as larger size and short-term liabilities as smaller size. That's how it should be for an ideal business. Okay, right. Now, to understand this liquidity concept, let's first digest this fund utilization principle.
Yeah, whatever you see on screen, I mean it. This fund utilization principle is going to be the very, very critical, important segment of this webinar. If you ask me what is going to be the key takeaway from this webinar, it's going to be this fund utilization principle. So please have your laser sharp focus, and whoever not having notepad and pen, please go and grab it. This is going to be the ultimate takeaway. This is going to be the savior for banking system. This is going to be the savior for entrepreneurs, stakeholders, employees, everyone. Such a powerful principle. Let's go ahead.
Whoever attending this webinar, whether you work in a bank or whether you are an entrepreneur or a finance manager or a chartered accountant or a cost accountant, okay, please take this principle to your heart, to your mind, and try to teach this to as many entrepreneurs as possible, because several businesses fail because of not understanding this principle. Okay, now listen. I said money for business can be raised from the owners, we call it as equity. It can be raised from outsiders, we call it as liabilities. And this liability can be short-term liability, and these short-term liability can be used for creating assets. They are called as short-term assets. But here if you look at short-term assets are greater than short-term liabilities, it means some portion of short-term assets are funded by long-term funds. I call them as long-term liabilities and equity. So this gives rise to the understanding that equity, the money contributed by the owner, is always long-term, and other long-term liabilities. Liabilities means repayable. So it can be a term loan, it can be a debenture. Okay, right. So if you look at the composition here, short-term assets are created using an entire portion of short-term liabilities and some portion of long-term funds, I call it. So you still have some more long-term funds which can be used for creating long-term assets. Now comes the fund utilization principle. If you are raising short-term funds, you can use it for creating short-term assets. It is good. If you are raising long-term funds, you can use it for creating long-term assets. That is also good. If you are raising long-term funds, you can use a portion of long-term funds for creating short-term assets. That is considered as ideal. But one thing that should never ever happen in any business is never ever use short-term funds for creating long-term assets. Never ever use short-term funds for creating long-term assets. Why do I say that? Short-term funds are raised with a promise that you will repay within 1 year. And if you want to repay within 1 year, you should have invested that money in short-term assets, because only those assets can be converted into cash within a period of 1 year, so that you can use that cash to pay back the short-term liability. On the other side, if you use the short-term liability on creating long-term assets, by very name, by very nature, they are long-term assets. It means those are all the assets which cannot be converted into cash within a period of 1 year. So you borrowed with a promise you will repay within 1 year. So when the due date approach, if you look back, you will not have short-term assets. What you will have is only long-term assets. Long-term assets, by very nature, by very definition, they cannot be converted into cash within a period of 1 year. Then you will carry sorry figure, or you will carry sorry face with your lender. Imagine that short-term liability, that short-term fund was given by a banker in the form of a cash credit or overdraft. And when they demands the repayment, and if you don't have a matching short-term assets because you have already used that money in long-term assets, what's your position? You will not be able to sell that long-term asset. But this lender, the banker who gave you that cash credit, who gave you that overdraft, will hardly wait for 90 days. 90th day they will classify the account as non-performing asset, and they will go for legal recovery measures, and that becomes the beginning of end of a business. Okay, so understand, diverting the short-term funds for long-term purpose is suicidal. Most of the business, they do not realize this. They think all money are same, but short-term money have very high pressure because they have to be settled in the short-term period. But long-term money, they are cool because you have to settle them over a period of time only. Just imagine you take a home loan, you have to pay over a period of 20 years. Your obligation will also be manageable. But for that entire home loan amount, if you go and take an overdraft, imagine the kind of pressure. Will you be able to settle that entire home loan amount within a period of 1 year? It will not happen, right? So if at all you raise an overdraft equivalent to home loan amount, and if you put that in constructing a house, it means you are not constructing a house, you are constructing something else which I don't want to mention, because it's going to put you in trouble. It will give you sleepless nights. Okay, so never ever do this. Let me give some numbers so that we can understand it better. I've raised short-term funds of 100 million, and I've used that funds to create short-term assets of 70 million only. So here comes the problem. I've raised short-term funds of 100 million, but the short-term assets what I have created out of it is only 70 million. So the question is, what happened to that remaining 30 million? And the answer is very obvious. It is not in short-term assets. They are in long-term assets. They are in long-term assets. So what I've done here, I've diverted the short-term funds of 30 million for long-term assets. And I've also raised some long-term funds of 70 million, which I've used for creating long-term assets of 70 million. So my total both sides are 170 million. But here what happened is, I've raised 100 million, of which I have spent only 70 million for short-term purpose. Then I did that blunder, unpardonable mistake of diverting the short-term funds for long-term purpose, 30 million. This is going to put this business in serious trouble, because the lender, whoever have given that 30 million, they will come and ask for the payment within period of 1 year. And for paying them, I don't have short-term assets, because the existing short-term assets is only 70 million. For that, there is a corresponding obligation of 70 million. Whereas for the remaining obligation of 30 million, I don't have short-term assets. What I have is only long-term assets. Long-term assets I cannot sell just like that. It will take its own time, and those lenders will not wait till I settle my long-term assets, or till I sell my long-term assets. Okay, that's where the problem starts, because bankers are permitted to wait only for 90 days. Then they have to go for legal enforcement. If it is a supplier's money, probably he'll give you 2 or 3 calls, then he'll go for legal enforcement. That's where the problem starts. Okay. So here there is a diversion of 30 million, and this 70 million they have used for a long-term purpose only. That's okay, but the blunder, the mistake, the sin what was committed here is diversion of 30 million short-term funds for long-term purpose. Okay.
So it's this principle which was not taught to entrepreneurs. It's because of not learning, it's because of not understanding this principle, several businesses lands into trouble. Several businesses lands into trouble because they were not taught or they were not given adequate caution of this principle. Do you know, in our country, more than 90% of the businesses, they fail, they collapse, not because of technology, marketing, product, HR, labor, sales, quality, technology. No. More than 90% of the businesses in this country, they collapse, they become sick, they become NPA only because of this single reason, that is diversion of short-term funds for long-term purpose. Had it been instilled on their minds that don't commit this mistake, this will put you into trouble, we could have saved several thousands of businesses. By the time the entrepreneur realizes that he had committed this mistake, he is in deep trap. Then they try to come out of it, but the chances are coming out of it is very, very remote, unless and until they have lined up some long-term funds to substitute this immediately. Okay, such a powerful principle, but given very less weightage, and because of that, several businesses in this country are collapsing, and this is sometimes even shaking the entire banking system itself. Okay, such a powerful principle. And how do you find this principle? Do you find this principle useful? Do you feel like it can, do you think it can save businesses? Do you think if entrepreneurs are taught on these lines, they can take care of their business, they can commit, they can honor their commitments, they can ensure their business is going to run smooth? If you type this is useful, type useful. If you find this it is super useful, please type super useful. Okay, because it's such a powerful principle, but not given due weightage. Not given due weightage. There is a study by RBI. It conducted a study on NPS, sick units. They asked for the reason, they identified the reason why business units are collapsing, why they have become sick, and they concluded that only 5% of the businesses have failed because of sales, competition, technology, HR, quality, those things. But remaining 95% of the businesses, they failed only because of this reason, diversion of short-term funds for long-term purpose. Okay, so understand this principle, and if you find this principle useful, I'm going to make a request also. The request is you have to take this message forward. Okay, please teach this principle to the entrepreneurs. Let him be a small business or SME, MSME, or mid-sized business, or even large business. Take that 2 or 3 minutes just to teach them. Okay, it can create such a wave kind of an impact. Okay, it can safeguard several businesses, not only businesses, the employees, dependents, the bankers, various stakeholders. Okay, everyone can be saved if they can appreciate the crux of this principle. Yes, I could see many of you are saying, yes, I will teach. Thanks a lot. Thanks for the support. Let's continue.
With this understanding, let's get into liquidity ratios. Liquidity ratios are broadly classified into 4 ratios, and in this webinar we are going to focus on the first one that's very important, that is current ratio. So current ratio scenario should look like this, because we know how to calculate current ratio, which is current asset by current liability. Okay, but current ratio scenario should be like this, that is current assets should be greater than current liabilities, and we calculate the current ratio like this, current asset by current liability. If current assets are greater than current liability, it means the resources are greater than obligations. Okay, let me take you through 3 scenarios. Look at this scenario 1, where the current liabilities are given. Okay, so this is total current liability, which is 300, and the resources that are available to settle that obligation is available. Okay, so the obligation is 300, resources are 600. So I think here the liquidity position is really comfortable. If I plot this in a form of a graph, the red bar indicates the resources, blue bar is the obligation, and here you can see there is a comfort zone. We call that as positive net working capital. How I have calculated? I've compared the current assets with current liabilities. So there are excess current assets. Excess current assets means that portion of current asset is not created by current liability, but they are rather funded by long-term funds. The portion of long-term funds used for creating current asset, we technically call it as net working capital. So if a business is having positive net working capital, it is a good sign, because to that extent that business will not have liquidity pressure. Okay, here they have 600 million as current assets and 300 million is the current liability. So they have pressure only for 300 million. For the remaining 300 million, they don't have pressure because it can be settled over a period of long time. Okay, that's what we understand when current ratio is like this, like 2:1. Let me give you another scenario. Here the current liabilities is same and current assets, there is a difference. Okay, look what's happening. Current liabilities are 300 and current assets were also 300. So you have an obligation of 300 million. For that you have resources of 300 million. It looks like a perfect scenario, but that's not the case. Okay, because let's say the bank CC has become due. This 100 had become due and you can settle that using your cash and bank balances. Then when this 200 becomes due, what are the assets you have? Only the stock and receivables. Let's say the receivables are getting converted into cash. That's good. So out of 200 you settle 100, but still you have another 100 pending. So what will you do? How will you manage? Because you cannot settle your suppliers with the stock. You purchase stock from them. You cannot pay them in stock. You have to pay them in cash. And you cannot tell them, please come and take back my stock. If you say so, then that becomes end of the credit business for you. You will not get credit from any suppliers in future, because that supplier will take care of the task of negative marketing for you. Okay, so that's why I said this scenario, even though it looks like an ideal scenario, it is not ideal. It's not an ideal scenario, because some of the current assets will not come for rescue when you want them very desperately. Okay, let me take you through scenario 3. And here the current liabilities are same, whereas current assets are comparatively lesser. Look at your current liabilities, it is 300. Look at your current assets, it is 200. So here you can see the problem. You have to settle 300 million within a period of 1 year, and for settling that you have resources of only 200 million with you. You have to settle 300 million, but you have only 200 million. So how will you manage that 100 million? That's the question. Okay, that indicates this business is going to land in trouble, number one. Number two, this will also communicate their financial discipline. They've raised 300 million short-term funds. They should have created short-term assets of 300 million, but what they have created is only 200 million. So the question is, what happened to that remaining 100 million? It's very obvious they have diverted it for long-term purpose, and they have committed that sin or blunder of diverting the short-term funds for long-term purpose, which will put that business into serious trouble. Okay, so if I put that in a form of a graph, look, the blue bar is the obligation and red bar are the resources, and clearly you can see there is a shortage, and to that extent this business is in a danger zone, because here the resources are lesser than the obligations. So when your current assets are lesser than the current liability, that is current asset minus current liability, obviously your net working capital will be negative. You will have negative net working capital. Okay, so let's capture all the three scenarios here. Scenario 1, current asset 600, current liability 300, so the net working capital was 600 minus 300, 300. Net working capital means the long-term funds which were used for creating current assets. So here if you see 300 long-term funds and 300 short-term funds put together, current assets of 600 was created. And if I look at the current ratio, it is 300 by 600, it is 2:1. In scenario 2, there is no long-term fund contribution at all, and the ratio is 1:1. And in scenario 3, 200 is the current asset, 300 is the current liability. It means there is a negative net working capital. Negative net working capital indicates a diversion of short-term funds for long-term purpose. So whenever you come across a negative net working capital, it means there is a diversion of short-term funds for long-term purpose. And whenever there is a diversion of short-term funds for long-term purpose, the current ratio will also be below 1. Here 200 current asset divided by current liability 300. 200 by 300, you are going to get the current ratio as 0.67:1. It means for every 1 rupee obligation, they have resources of only 67 paise, which clearly shows there is a shortage. Okay, and this also means that there is a diversion of fund. At this point, I want to ask you a question. Since some of you or most of you are working in bank, what is the minimum current ratio insisted by your bank? What is the minimum current ratio insisted by your bank?
Yeah, please type. Yes, I could see the current ratio, minimum ratio coming like 1.33 pouring, then 2, 1.17, and I see 1.33 as majority, 2, 1.5, 1.2, 1.1, 1.17. See, this could also vary based on whether the borrower is into manufacturing, is into trading, is into services, okay? And it could also sometimes vary based on industry, okay? That's about the different level of current ratio. And here once again I want to stress on one element, that is, I said, when they are diverting short-term funds for long-term purpose, the consequences can be very serious. If you have really focused, I would have used harsh words like sin, blunder, unpardonable mistake. All this are actually carefully selected words, okay, to convey its seriousness. uh, I, I visited one unit, okay, one unit that is between Coimbatore and Palakkad here in Kerala. That was set up somewhere in 1990s. At the time, it was set up at a cost of close to 95 crore. Okay, that unit, when they were about to complete their project for some 2 crore machinery, they used some short-term funds, used the short-term funds of 2 crore, and they purchased that machinery and erected it. But by definition, short-term funds are repayable within 1 year. Okay, so within 1 year, that person who gave that short-term fund came and asked for the repayment. But this unit has not lined up long-term fund adequately at the time, so they were not in a position to repay that 2 crore. Imagine, this is a unit set up at a cost of 95 crore way back in 90s. Okay, they couldn't pay the 2 crore. But the person who gave the 2 crore, for him, the 2 crore is a big amount. So he insisted it should be paid. The company was not in a position to pay. So he approached the court of law. Court said, nothing doing. You pay him 2 crore. Otherwise, if you're not paying, we are going to pass an order to close this company, liquidate, sell the assets, and then pay. This company, probably it was their worst time. They could not arrange some other long-term funds. They couldn't pay. So court passed an order for liquidating this company. Then what happened? A liquidator was appointed. They were trying to sell the assets. See, it was so many plant and machinery, mega size plant and machinery. I actually visited that unit somewhere some 4 or 5 years back. And what I could witness was, it's, see, nothing on the screen. Okay, don't worry. What I witnessed there was, it's a crores and crores of junk scrap. Why? Because this order was passed to settle them. They were trying to sell the assets to settle. Since it was kind of some unique, I mean, they were kind of first of kind in the market. So those machineries were not saleable. And it is somewhat a remote place in Palakkad. So there were no taker for that space also. And for several years, they were trying to sell. The sale did not happen. That person who gave the 2 crore, he didn't get money. Okay, everything went on for a toss, and it was like bleeding because so much of scrap. The unit which was about to take off and put on a massive show has actually become a scrap. Okay, and nothing is fabricated here. This is something which I've literally seen in my own eyes. Okay, that's the kind of impact or devastation this diversion of short-term funds can create. Okay, so I just wanted to stress on that. And I could see many of you have commented on the current ratio. Let's see.
Shall I take a couple of minutes to explain the logic behind a minimum current ratio of 1.33? Why banks are insisting on minimum current ratio of 1.33? Shall I explain?
Can you all just type BIO? BIO stands for bring it on. It's a connectivity check. Okay. So if you're typing BIO, it means you can hear, you can see what I'm saying. Yeah. Thanks a lot. Thanks a lot. And one assurance I'll give you, this will explain the logic behind minimum current ratio of 1.33. Whoever working on current ratio who didn't know what is the exact logic of 1.33 or for that matter 1.1 or 1.5, this will open up the logic. Okay, it's not a rocket science, but it will beautify. Okay, you will start falling in love with what you're doing.
Okay. Let's say I have current assets of 100 million and current liabilities of 75 million. And with this information, if I calculate the current ratio, it will be current assets by current liability, and it is 100 by 75. So it is 1.33. 100 by 75, and it is 1.33. So what I can infer is, when my current ratio is 1.33, it means 75% of the current assets are funded by current liabilities. And what is even more important is the remaining 25% of the current assets, that is current asset minus current liability, the remaining 25% of the current assets are funded by long-term funds. Funded by long-term funds, we technically call them as net working capital. So when the current ratio is 1.33, we can safely conclude that 25% of the current assets are funded by long-term funds. It means there is a 25% long-term fund contribution for creating current assets, and that's what most of the banks stipulate as margin for working capital. For example, if you go and check the sanction letter issued by most of the banks, they would have stipulated 25% margin for working capital credit facilities. Even if you look at the Tandon Committee recommendation for arriving at working capital, they said that 25% of the current assets have to be funded by margin, and it is only the remaining 75% banks can explore funding. Okay, it means there should be a 25% contribution of long-term funds for creating current assets, and that is verified, or that is checked through current ratio. If current ratio is 1.33, then there is 25% contribution. If it is greater than 1.33, then there is greater than 25% contribution, and if it is less than 1.33, then there is less than 25% contribution. And that's the reason most of the banks insist on current ratio of 1.33. Okay.
Yes, this is the logic behind minimum current ratio of 1.33. How many of you find this as bulb on moment, or it's something which has opened up the logic? Just type bulb on or simply type BO. I see that as certificate for my teaching skill. Yeah, thank you. Thank you, Shashikaran, Shweta, Seshmer, Suresh, Praveen, Devendra, Gopal, Deepak, Pooja Shah, Satyamurthy. Yeah, it's running. Thanks a lot.
Now let's move on to capital structure ratios. Under that, there are three ratios, but here we are going to discuss about what is important from bankers' point of view, that is debt to equity ratio. In debt to equity ratio, what we'll be doing is we'll be comparing the debt with equity to understand the long-term solvency of a business. Let me take you through a balance sheet. I'm just going to show you the left-hand side, that is the equity and liability side. Look at this, shareholder funds are 100, bank loan is 100, debentures are 100, and sundry creditors are 200 million. It means this business has raised 500 million from 4 different parties: owners 100 million, from bankers 100 million, from debenture holders by issuing debentures 100 million, and from suppliers, sundry creditors 200 million. Now what we have to do, what we are trying to understand, it is debt equity ratio. So we have to compare the debt with equity. Equity is the owner's money. In this case, it is this 100. And debt is the sum of all the three. We call them as outside liabilities, and it is 400. So let's compare the debt with equity. Debt is 400, equity is 100, and the formula for debt equity ratio is debt divided by equity. 400 by 100, we get the value as 4. Let me take you through a scenario, a 3-case scenario, so that we can understand it better. The first scenario what we are discussing now is total outside liabilities of 400, equity, the money contributed by the owners, as well as the profits that are attributable to them put together, we call it as equity, 100. So if I calculate the debt equity, that is total outside liabilities divided by equity, 400 by 100, I get the value as 1, and we express it as 4:1. It means for every 1 rupee contributed by the owner, this business has borrowed 4 rupees. For every 1 rupee contributed by the owner, this business has borrowed 4 rupees. So what we can understand, if this business is raising 5 rupees, 4 out of 5 rupees is by outsiders and 1 out of 5 is contributed by the owners. That's what you see here. Outsider share are 4 out of 5, that is 80%, and owner's share are 1 out of 5, that is 20%. So what's happening here? In this business, owner's stake is very less, whereas outsiders have contributed more, and I see this as highly risky proposition. Because this 80% of the funds which had come into the business would not have come free. They would have come with a cost, and these costs have to be met, let whatever be the situations surrounding the business or affecting the business, because they are all fixed cost. Look at this, in this case 400 million they have raised as debt, and they have to pay interest, they have to pay principal, let whatever be the market condition. Only in rare exceptional circumstances the regulators will step in and give direction to the banking system to not to demand for payment for some time, like what we have COVID. Reserve Bank came and said give them moratorium for 3 months, then give moratorium for another 3 months. Okay, but it will not happen every year. It happens only in rare situations. So in this case, this 400 million, they have an obligation, and that has a fixed cost in the form of interest, in the form of loan principal repayment, and they have to be met. And if for some or the other reason, if their sales comes down, and if they are not in a position to meet that commitment, meet that obligation, this business will get affected to the core. Because whoever have given money, they'll not wait for long. They go for legal recourses, and that could come as a big blow for the normal operations of this business. Okay, so that's why I say 4:1 is a highly risky scenario. Let me give you a second scenario where the outside liabilities are 333 and equity is 167. I chose these numbers to convey an important message. Because look, the total funds are 500. Here also it is 500 only, but I've chosen a different proportion. The proportion works like this. If you take the debt 333 and if you divide it by equity of 167, you get the debt equity ratio as 2. We express it as 2:1. It means for every 1 rupee contributed by the owners, this business is borrowing 2 rupees. It means if this business is raising 3 rupees, 2 out of 3, that is 2/3, that is 67% is coming from outsiders, and 1 out of 3, that is 33% is coming from owners. And for me, this is much better than scenario 1. In scenario 1, outsiders contribution are 80%, where in scenario 2 it is only 67%. To that extent, there will be reduction in fixed cost as well. In scenario 1, owners have contributed only 20%. In scenario 2, owners are contributing 33%. I see that as a good sign, because owners will be investing more of their money when they see their business is more promising. Let me take you through scenario 3, where total outside liabilities are 250 and equity is 250. Again, I have maintained the total as 500, but I have changed the proportion. So what is the debt equity ratio now? 250 by 250, it is 1:1. It means if this business is raising 2 rupees, 1 out of 2, that is 50% share is coming from outsiders, and 1 out of 2, 50% share is coming from owners. And this is much better than the first and the second scenario, because here the outsiders share have come down, and as a result the fixed cost related to that will also come down. Fixed commitment, fixed obligation will come down. This will reduce the burden, it will reduce the pressure on the business. And owners are investing 50% it means they know this business is very much promising. That's why they are committing their money. So what is an indication? The indication is scenario 1 attracts high financial risk. Scenario 2 we say ideal, and scenario 3 is the best. Okay. So this ratio, that is debt equity ratio, or we call it as TOL, total outside liability, by TNW, that's basically the equity. Okay, that communicates the long-term solvency. Businesses with a high level of ratio will have a high financial risk, and because of that, it's possible that during recessionary market conditions, those businesses may not be able to withstand, they'll get washed away. Because when their sales comes down, and if their fixed cost is going to remain fixed only, it means the impact is reduced sale, higher fixed cost, so the profit will turn out to be loss, and that business will have its natural death. Okay, so that's what we are trying to understand through this debt equity ratio. So whoever working in bank, you will know, because you will be carrying out credit rating of the customers, and in my experience, the highest weightage is given for the single ratio, that is debt equity, or we call it as total outside liability by tangible net worth.
So that's about debt equity ratio. Can you just comment on what is the maximum debt equity ratio acceptable by your bank, or I would say tolerable by your bank? Raghavendra is saying 3:1. Rahul is saying 5. Okay, 5 means you are on the higher side. Deepthi 2.5, conservative. Uma Mageshwari 4:1, slightly aggressive. Mohit is saying 3. Abhishek, he's very specific, 4 for manufacturing. So it could vary for manufacturing, for trading, for services, it could vary. Okay, and it also would vary based on the risk appetite of the bank. Okay, so we cannot give a one size fits all approach. Bank to bank, it could vary. Depending upon the manufacturing, trading, services, also it could vary. So please go and have a look at loan policy guidelines of your bank. Okay, here I have given you the foundation. I've explained what this ratio communicates. Now have a look at what does your loan policy guidelines say and go by that. Okay.
Next, we'll move on to coverage ratio. In that, first I'm going to explain debt service coverage ratio. We call it as DSCR. This ratio is calculated to measure the repayment capacity of a borrower when he approaches a bank for a term loan. So how repayment capacity is measured? It is measured by finding out the cash profit available for debt service and comparing that with the repayment obligation for every year, which is interest plus principal. So here, how this cash profit available for debt service is computed. Let me show. What we do is we take profit after tax and dividend. With that, depreciation will be added back. Reason being, depreciation is a non-cash item. Not even a single penny cash goes out in the name of depreciation. Okay, since we want to find out cash profit, what we do, we add back depreciation, because while arriving at the profit after tax, this depreciation was subtracted as an expense, but no cash goes out, so we are adding back depreciation. Then we are also adding interest, not because it is a non-cash item, but because we want to know what is the cash profit available for paying interest and principal. If you want to know what is the cash profit available for paying interest and principal, you cannot take cash profit which is after paying interest. Okay, because we are starting with profit after tax and dividend, right? This profit after tax was arrived after subtracting all expenses, which also include interest. So let us add back that so that it gets nullified. So by doing this, taking profit after tax and dividend, and by adding depreciation and interest, we arrive at cash profit, and this is the formula followed by most of the bankers. Let me take you through an example so that you can understand it better. Look at the statement. This particular business has made a sales of 1,000. Their direct cost is 500. Their gross profit is 500. Operating expenses are 100. Depreciation is 100. Interest on loan is 100. So from sales, direct cost was deducted 500. They had a gross profit of 500, and we are deducting 3 expenses. So from gross profit, when we deduct all the 3 expenses, we get the profit before tax. So 500 minus 300, you have plus 200. From that, let's deduct tax at 50%, which is 100. So you get profit after tax of 100. Now listen. For computing debt service coverage ratio, what we have to do? We have to take profit after tax. With that, we have to add back depreciation and interest on loan. In this case, there is no dividend, so we are starting with profit after tax. So 100 plus 100 plus 100, 300. This becomes the cash profit. This cash profit have to be compared with the repayment obligation, which is basically interest on loan of 100, what we have seen, plus interest on principal I am giving you, which is 100. So what is the total obligation? 200. What is the cash profit? 300. Now we can find out debt service coverage ratio. DSCR is equal to profit after tax and dividend plus interest on term loan plus depreciation divided by interest plus principal. In this case, it is 300 divided by 200 and you get as 1.5 times. You get the value as what? 1.5 times. And what does that communicate? For every 1 rupee loan obligation, which is interest plus principal, this business is having a cash profit of 1 rupee 50 paise. So it looks good, right? Because for paying 1 rupee, they are having a cash profit of 1 rupee 50 paise. It means from 1 rupee 50 paise, 1 rupee can be paid off. Still 50 paise is available with that business. They can use that 50 paise for supporting their working capital requirements. Okay, right. Now I want to ask you a question. What is the minimum DSCR insisted by most of the banks? If you're working in a bank or if you are exposed to this concept, please give your answer. What is the minimum DSCR insisted by most of the banks?
So please type what is the minimum DSCR? Yeah, I could see like 1.25, 1.5, 1.67. Okay. Varied numbers. And anyone working in public sector bank, what is the minimum DSCR? Yeah, 1.5 to 1.75. Okay, it varies. Let's see.
Okay. 1.1 will be insisted by the banks who are ready to take risk. Okay, because 1.1 is a very small ratio. If they are okay with that, it means they are willing to take more risk. It means the side effect is the interest rate will be very high. 1.5 is accepted by most of the bankers and 1.75 is insisted by public sector banks, okay, who are very conservative. They'll be insisting a DSCR of 1.75. Now let me take a couple of minutes to explain the DSCR rationale, why some banks are insisting on 1.75 times or say for that matter even 1.5 times. Why banks are insisting on DSCR of 1.5 or 1.75 and not just 1? Because if DSCR is 1 for paying loan obligation of 1, they are having resources of 1, why not banks stop with that? Why they are insisting on 1.5 or 1.75? Shall I explain?
Yeah, please type BIO. It's an internet connectivity check, and this is something which you will really enjoy. Many of you got bulb on moment in current ratio. No? It will be even more brighter in this. Yeah, thank you.
Okay, let me explain the rationale behind this minimum DSCR. Look at this. If DSCR is 1.75 is to 1, it means for every 1 rupee obligation, there is a cash profit of 1 rupee 75 paise. So from 1 rupee 75 paise, 1 rupee can be paid, and what is left with the business is this 75 paise. This 75 paise is the profit after tax, after dividend, after paying interest, and after paying principal also. So it basically goes as retained profit, and this retained profit will go to a head called reserves and surplus in balance sheet under the head equity. And equity along with other long-term liabilities will become long-term funds, and that long-term funds can be used for supporting working capital margin. If this does not make sense for you, worry not. Look at this. Your statement of profit and loss only communicates what is profit. From that we calculate cash profit. Then we compare that with the obligation and we arrive at DSCR. And if DSCR is 1.75, it means out of 1.75, 1 can be paid, 0.75 can be retained in the business. And I told you that this retained profit will go to balance sheet under the head reserves and surplus. So now this reserves and surplus along with capital will be called as equity, and this equity along with the long-term liabilities will be called as long-term funds. These long-term funds can be considered or can be used for creating long-term assets. I repeat, these long-term liabilities can be used for creating long-term assets. But if you look at the proportion, look, you have so much of long-term funds, but only a portion of long-term funds has been used for creating long-term assets. It means there is some surplus. So what's going to happen here? This business is also raising some short-term funds. It is creating short-term assets. The short-term assets are more than the short-term funds. How it was made possible? Because short-term funds are very small, but short-term assets are much bigger than that. It was made possible because the remaining surplus of long-term funds, has been utilized for creating this short-term assets. Now try to link with our fund utilization principle. We said a portion of current asset should be funded by short-term funds and another portion should be funded by long-term funds. Because I said I marked it as ideal. Utilizing the long-term funds for creating short-term assets is ideal because that is going to relieve the business from liquidity pressure. So if a business is having a DSCR of 1.75, that 0.75 gets retained in the business. It gets retained. It becomes part of long-term funds. So that long-term funds, after being utilized for creating long-term assets, there will be some surplus. That surplus will in turn get utilized for short-term assets, and this is what we call as long-term funds used for creating short-term assets. Technically this is the net working capital. Okay, so it is not that mere profit along with capital, along with the long-term liability, they all become put together long-term funds, and they are actually supporting short-term asset creation. So this is the logic. I hope you would have understood.
So if you have understood the logic behind DSCR, why banks are very particular about a level like 1.75, for that matter even 1.5, 1.1, and if you got that logic cleared with this explanation, please type BO. BO stands for Bulbon, and it means you are getting value from the time you have spent in this webinar. And I also see that as a certificate of appreciation for my teaching, which I love at most. Thanks a lot. In the beginning, I have stressed, or I have laid so much of stress on fund utilization principle because it's such a powerful principle. If taken care, it can safeguard the business, and if not attended to, then it can kill a business. Okay, that's the kind of power of that principle. But where do you see that in practice? Okay, is it a theory? Whether you can check its real application through any of the tool? If you ask me, the answer is yes, and that is fund flow analysis. Okay, fund flow statement. If you analyze the fund flow statement, we call it as fund flow analysis. You get to know what is exactly happening in a business. It's going to be like a master health checkup report. Okay, so please have your focus.
I need your participation here. Look at this. There are 3 companies A, B, C, and you have information about their long-term sources and short-term sources, total sources. You have information about their long-term uses, short-term uses, and total uses. I want you to digest this information. Spend some time and then identify which company is in trouble here. Is it company A or company B or company C? Company A, they've raised long-term funds of 50. They've raised short-term funds of 50. So total of 100, of which 50 is used for long-term, 50 is used for short-term. Company B also raised in the same pattern, but of which 70 is used for long-term and 30 only used for short-term. And C raised in the same pattern, but of which 30 only used for long-term and 70 is used for short-term. So you have to tell me like which company is in trouble.
Yeah, please think over and tell me like which company is in trouble. All that glitters is not gold, and all that looks like troublesome may not be troublesome also. Okay, that's what this analysis is going to reveal. For some, it might look C is in deep trouble. For some, it might look A is picture perfect. For some, it may be little difficult to come to a conclusion whether it is B or C. Okay, so let's see.
Let's see the results. I'm going to rearrange this statement. Let me bring the long-term sources here and I'll compare that with long-term uses. So let's see what is the position. If you take company A, long-term sources and uses are same, so no surplus, no deficit. But company B, long-term source is 50, long-term use is 70, so there is a deficit of 20. And company C, long-term source is 50, long-term use is 30 only, so there is a surplus of 20. And now let me take short-term sources. I'll compare that with short-term uses. And let's see what is the position. For company A, obviously no surplus, no deficit. But company B, they raised a short-term fund of 50 and used only 30, they had a surplus of 20. And company C, they raised only 50, they've used 70, they had a deficit. So it might look like company C is in trouble because they had deficit and company B is comfortable because they had surplus, but that's not the understanding. Understanding, pay attention here. Company B, they raised a long-term source of 50, but they created a long-term use of 70. How is that possible? With 50, you cannot create 70. So from where they got the remaining 20? Obvious, they got that remaining 20 from here. So this short-term surplus of 20 with the long-term source of 50, they got money worth 70 million, which they have used for long-term purpose. And because of this reason, we say company B is in trouble. Because company B, they raised a short-term source of 50 and their short-term resources are only 30. It means they are supposed to repay 50 million in 1 year. With that promise, they raised 50 million, but what they have done is they have created only 30 million worth of resources. They have simply diverted 20 million for long-term purpose. So within 1 year, they are supposed to repay 50 million, but they have resources only 30 million with them. So whoever have given that 20 million, they'll go for legal action against this company for not fulfilling the obligation, for not fulfilling the promise. For not fulfilling the promise. In this case, company B, they'll not be in a position to fulfill the promise because that 20 million they have invested in long-term asset. Long-term use. It can be land, building, plant and machinery, and you cannot sell them just like that. It will take more than a year, but they will not wait for more than a year. Okay, that's why we say company B is in trouble. But if you look at company C, they've raised 50 million long-term, they've spent only 30 million, they had a surplus of 20 million. And that surplus of 20 million along with short-term fund of 50 million, they've created short-term use of 70 million. And if you look at it from the other side, within 1 year they are supposed to pay 50 million, and for paying that 50 million, what are the resources they have? 70 million. That's why we say company C is in comfortable situation. Okay, right. So this statement which helped us to get more clarity is fund flow statement. Let me give you a real life fund flow statement. It will look something like this. Okay, it's basically part of it. Look, here you have the sources and here you have the applications. Sources we basically call as long-term sources. Application we call as long-term uses, like what we have seen here. Okay, now look at this. Let me analyze this also so that you will get complete clarity about fund flow analysis. And here I'm not teaching you how to prepare fund flow statement, but I'm teaching you how to read the fund flow statement. Okay, look, in 2018-19, they had long-term sources from operations and by selling investment of 5,650. And these are all their long-term uses. They purchased plant and machinery, they paid taxes, they paid dividend. Okay, so 5,650 was the source, 6,200 was the use, there was a deficit of 550. Let's analyze this. So what is the total source? It is this 5,650. Okay. When they had 5,650, what they did? They first purchased plant and machinery. Okay, not first, they purchased. Okay, all right. Since they had so much of fun, okay, 3,700 is okay, because even after paying all this, they'll have a surplus of 1,950. And then what they are supposed to do? Tax is compulsory, they cannot escape. Okay, from 1,950, they paid taxes of 1,100. So they are left with 1,950 minus 1,100, 850. Okay. When they are left with 850, they did this mistake. When they are left with the long-term fund of 850 only, what they did? They went and paid dividend of 1,400. What is the amount they have? 850. But what is the dividend they have paid? It is 1,400. How? It's not acceptable, right? But they did that. How? They went and paid 1,400. They faced a shortage of 550 and they have managed that shortage by using short-term funds. Okay, so here there is a deficit, and this deficit was managed because they took some short-term funds. A simple example can be a cash credit or overdraft, because they wanted to pay 1,400 to their owners, but they have only 850. So what they did? That 850 plus money available in cash credit or overdraft to the extent of 550 put together, they have paid dividend of 1,400. So this shows their financial discipline. When they have only 850, why they are paying 1,400? That's not right, right? I mean, this is not a wise approach. Or ideally what this business should have done, when they have purchased plant and machinery of 3,700, here they should have raised some long-term funds. So some portion of this 3,700 could have been funded by long-term funds, and that would have left good amount of surplus so that they could have paid this dividend easily. Or the other way is, when they have an investment to take place like this to the extent of 3,700, why they are paying dividend? They could have used this money for funding that, right? They didn't do. They paid dividend when they don't have adequate funds. When they had only 850, they paid 1,400. They simply diverted short-term funds for long-term purpose. So this is what happened in 2018-19. In 2018-19, or ideally they could have done one thing. When they are left with the long-term funds of 850, they should have restricted their dividend to 850. In that case, there will not be any diversion of short-term funds for long-term purpose. But even it should not be like that, no, because there should be some long-term surplus contributing for working capital of the business. Here, instead of contributing, they have stolen the money from cash credit for paying as dividend to the owners. Okay, see how powerful the statement is. It is revealing what was hidden. Let's see what happened in 2019-20. In 2019-20, their funds from operations have improved significantly. They've also raised money by issuing debentures. So it is 7,800. And from that, they are purchasing plant and machinery. Okay, they have a lot of money, let them. It means after purchasing plant and machinery, they have surplus of 5,025, and they want to pay taxes. Okay, good, let them pay. So from 5,025 taxes paid, what is left over now? 3,325. From that, they want to pay dividend. Okay, let them pay 2,250. It means the balance left over is 1,075. At this point, they should have put a break. But what they did, they went and purchased an investment of 1,500. When they are left with the funds of only 1,075, it means this is the grave mistake which they should not have committed. 1,075 is the surplus, 1,500 investment, not in their business. They have purchased investments, some shares or stocks of some other company. By using whose money? By using some short-term money. Look, they have only 1,075, but how they spent 1,500? The 1,075 plus 425 gave them 1,500. They've invested in someone else's business. This business is not learning from its mistakes. When they are left with 1075, they should have stopped at that level. They should have ensured that this money is going for supporting the working capital requirements of the business, but they didn't do. Okay, so these kind of all hidden practices will get caught, will get revealed in fund flow statement. In my 4 year of stint in State Bank of India, the statement for which I had high regards is the fund flow statement, because this is one master health checkup report which will reveal all the hidden problems of the borrower. I mean, if at all you will get awestruck, or if at all you will become unanswerable in one statement, means that is fund flow statement, because it is so clear. Okay, because it shows no, like from where they got money, where they have used. See, they have paid dividend in 1819 when they didn't have money. They've invested in someone else's business in 1920 when they did had money. So this all shows the intentions, the integrity of people behind the show as well, not just numbers. It also goes deeper into qualitative aspects. So that's the power of fund flow statement. So develop your skill in reading fund flow statement. Such a powerful statement. Okay, all right. So with this, I wish to conclude this presentation, and I believe most of you would have had a bulb on moment. So if you really had a bulb on moment, please type bulb on.
Yes, please type bulb on if you derived value from the session, if you have learned something critical, meaningful, sensible, important for your job, for your career. Please type bulb on, and that I see as my personal certificate of appreciation as well. Thanks a lot. Thanks a lot. What you have seen now is only the tip of the iceberg. What you have seen now is only the tip of the iceberg. But the best part is you have understood whatever I have explained so far. Thank you very much. The reason why I say it's a tip of the iceberg is because in reality, when you do the credit appraisal, when you do the financial analysis, you have to read balance sheet line by line. You should focus or put your attention on every item in balance sheet. You have to analyze various set of financial ratios. There will be liquidity, solvency, profitability, return on investment ratios, various set of ratios. Then you have to study the cash flow statements in depth. You have to focus on item by item items. You should see where they generated money, where they have used, how they have used. Then you should also study their fund flow statement in depth, and again in between the lines, to identify whether any fund diversion have taken place. Then you should develop special skill for assessing the working capital requirement of the borrower. Here you got to empathize with the borrower, but at the same time you should also protect the bank's interest. Next, you should be able to put up a comprehensive loan proposal if a borrower comes for a term loan for putting up a project, because this requires viability study. You have to look into their repayment capacity, DSCR, fire, break even, sensitivity, and so on. Next, you should also be able to work seamlessly on CMA report, the basic Excel document which captures the past financial data as well as the current estimate and projection. And from this only all kind of analysis will happen. Next, you should be able to arrive at credit risk rating for the borrower. You should be able to come across different types of business entities, business models profile, and you should also be able to understand the forex impact on import export transactions. So what all this means? All this means you got to learn more, right? So how many of you are really ready to learn more? Because once again, I reiterate, what I have showed you today is only tip of the iceberg. So how many of you are interested in learning more? If you are really interested in learning more, if you want to take this journey to the next level, if you want to improve your skills that is required for your job, and that's the fundamental for your banking career, then type ILM. ILM stands for I am interested in learning more. ILM stands for I am interested